welcome. In this video we will look at the short strangle trade. You may remember from my video on short straddles that a short straddle is a trade where the trader sells two options on the same stock, a call and a put, that both expire at the same time. A short strangle is similar to a short straddle. However, for a short straddle the trader sells two at-the-money options that have the same strike price, and with a short strangle the trader sells two out-of-the-money options. Selling both a call option and a put option creates a range around the current price. If the price of the stock remains within that range, the trade is profitable. In other words, the trade is profitable if the price of the stock does not go above a certain price or below a certain price before the options expire. If the price of the underlying stock is between the call strike price and the put strike price when the options expire, neither option has any intrinsic value. This means that both options expire worthless, and the trader keeps the full premium that he was paid for the options as profit. The full premium he was paid up front is his maximum possible profit for this trade. If the price of the stock is above the call strike price, the put option still has no intrinsic value. However, the call option does have intrinsic value, which means that the profit this trader made selling the options declines by that value. If the price of the stock is above the upper break-even point, the loss on the call option exceeds the premium the trader was paid for selling both options, resulting in a loss on the trade. If the price of the stock is above the call strike price, the trader's profit or loss is the premium that he collected up front selling the options, minus the difference between the current price of the stock and the strike price. If the price of the stock is below the put strike price, the call option still has no intrinsic value. However, the put option does have intrinsic value, which means that the profit the trader made selling the options declines by that value. If the price of the stock is below the lower break-even point, the loss on a put option exceeds the premium that the trader was paid for selling both options, resulting in a loss on the trade. If the price of the stock is below the put strike price, the trader's profit or loss is the premium that he collected up front selling the options, minus the difference between the strike price and the current price of the stock. Let's look at an example using GLD, the gold ETF. At the time of making this video, GLD is currently $129.09 per share. A trader could place a short straddle on GLD by selling the $130 call option and selling the $128 put option that both expire in about 6 weeks. The call option costs $2.07 and the put option costs $2.04. Selling both means that the trader collects a total of $4.11 per share up front for selling the options. This means that for the trade to be profitable, the price of GLD must remain within $4.11 of the strike prices. In other words, for the trade to be profitable, the price of GLD has to remain above $123.89 and below $134.11 up until the time the options expire. If the price of GLD is between the $130 call strike price and the $128 put strike price when the options expire, neither option has any intrinsic value. This means that both options expire worthless, and the trader keeps the $4.11 that he was paid up front. The $4.11 premium the trader was paid up front for selling the options is the trader's maximum potential profit. If the price of GLD rises above the $130 call strike price, or if it drops below the $128 put strike price, one option still has no intrinsic value. However, the other option does have intrinsic value, meaning that the profit the trader made selling the options declines by that value. If the price of GLD is above the $130 call strike price, the trader's profit or loss is the $4.11 premium that he collected up front selling the options, minus the difference between the current price of GLD and the $130 strike price. The upper break-even point is $134.11, so if the price of GLD is above $130, but below $134.11, the trader's profit is between $0 and $4.11. If the price of GLD rises above $134.11, the trade loses money. If the price of GLD falls below the $128 put strike price, the trader's profit or loss is the $4.11 premium that he collected up front selling the options, minus the difference between the $128 strike price and the current price of GLD. The lower break-even point is $123.89, so if the price of GLD is below $128 but above $123.89, the trader's profit is between $0 and $4.11. If the price of GLD falls below $123.89, the trade loses money. So that's the short strangle trade. In the next video, we will continue looking at the short strangle, by comparing a short strangle to a short straddle, as well as looking at other contract choices a trader could choose when placing a strangle. I hope that you enjoyed this video. Thanks for watching. Hello and welcome. In this video, we will look at examples of a short straddle and two short strangles that a trader could place on Microsoft. At the time of making this video, Microsoft is $40.98 a share. A trader could place a short straddle by selling the $41 call option and selling the $41 put option that both expire in about 6 weeks. The call option costs $1.24 and the put option costs $1.45. Selling both means the trader collects $2.69 up front. The strike price is $41 and the trader is collecting $2.69 up front for selling the options, so for the trade to be profitable, the price of Microsoft has to be within $2.69 of the $41 strike price. In other words, for the trade to be profitable, the price of Microsoft has to be above $38.31 and below $43.69 when the options expire. Instead of a short straddle, the trader could place a short strangle by selling the $42 call option and selling the $40 put option. The call option costs 82 cents and the put option costs $1. Selling both means the trader collects $1.82 up front. This means that, for the trade to be profitable, the price of Microsoft has to be within $1.82 of the strike prices. In other words, for the trade to be profitable, the price of Microsoft has to be above $38.18 and below $43.82 when the options expire. The trader could also place a short strangle using options that are further out of the money by selling the $43 call option and selling the $39 put option. The call option costs 49 cents and the put option costs 65 cents. Selling both means the trader collects $1.14 up front. This means that for the trade to be profitable, the price of Microsoft has to be within $1.14 of the strike prices. In other words, for the trade to be profitable, the price of Microsoft has to be above $37.86 and below $44.14 when the options expire. Let's flip the price chart on the side and look at the potential profit as well as the break-even points for each choice. The x-axis shows the price of Microsoft at expiration. The y-axis shows the profit or loss. The short straddle trade has the highest possible profit at $2.69 per share maximum. However, the range that price must remain within for the trade to be profitable is the most narrow. The strangle that is closer to the money has a lower maximum profit than the short straddle, but it also has a larger range that the price of Microsoft can move without the trade losing money. The strangle that is further out of the money has the lowest possible maximum profit, but it also has the largest range that the price of Microsoft can move without the trade losing money. Looking at the three choices, for the short straddle, the maximum profit is only obtained if the price of Microsoft is exactly at the $41 strike price when the options expire. If the price is even 1 penny away from the $41 strike price when the options expire, the profit level declines. For instance, let's say the price of Microsoft is at $41.50 when the options expire. $41.50 is above the $41 strike price, so the put option expires worthless. However, the call option has 50 cents worth of intrinsic value. The price of Microsoft is at $41.50, and the trader sold the right for someone to buy the stock from the trader for $41, so the trader loses 50 cents per share on the stock. However, the trader received $2.69 up front selling the options, so his profit is the $2.69 that he received up front, minus the 50 cents of intrinsic value, for a profit of $2.19. The trader received $2.69 up front, so the break-even points become the $41 strike price, plus or minus $2.69, or specifically $38.31 and $43.69. At these 2 points, even though one option still expires worthless, the loss on the other option exceeds the upfront collected premium. For the near-money short strangle, the maximum profit is obtained if the price of Microsoft is between $40 and $42 when the options expire. So while the short straddle only obtains maximum profit if the price of Microsoft is exactly at $41, the short strangle obtains maximum profit if the price of Microsoft is anywhere within the $2 range of $40 to $42. For the further out of the money short strangle, the maximum profit is obtained if the price of Microsoft is anywhere between $39 and $43, which means that the maximum profit has a $4 range compared to only a $2 maximum profit range for the near money short strangle and no range for the short straddle. Looking at all three choices, it is important to note that the straddle has the highest potential profit, but as price moves away from the strike price, the potential profit declines at the fastest rate. Likewise, the near money short strangle has a higher potential profit than the further out of the money short strangle, but the potential profit declines at a faster rate as well. For instance, if the price of Microsoft was at $38.50 when the options expired, all three choices would still be profitable trades. However, the short straddle, which received the highest upfront premium, would be the least profitable. The trader collected $269 up front, but the put option has $250 worth of intrinsic value, so his profit is only 19 cents a share. The near money short strangle collects a premium of $1.82 up front. If Microsoft is at $38.50, the put option has $1.50 worth of intrinsic value, meaning that the profit for this trade would be 32 cents per share. At $38.50, the short strangle using the further out of the money options has the highest profit. Selling a $43 call and a $39 put means the trader collected $1.14 up front. The call option expires worthless, and the put option has 50 cents worth of intrinsic value, so the profit on this trade is 64 cents, twice the other short strangle. So that's looking at a short straddle and two short strangles on Microsoft. I hope that you enjoyed this video. Thanks for watching.